You Can Be a Stock Market Genius by Joel Greenblatt. Picture this. A building literally disappears into the earth. For a young investor in the 1980s, this wasn't just bizarre news. It was a financial nightmare unfolding in real time. He'd invested in a theme park called Cypress Gardens, which had just agreed to be bought out by a bigger company. Everything looked solid. He was expecting an easy, predictable profit. Then the ground literally opened up and swallowed the main pavilion whole. The deal collapsed. His sure thing was suddenly teetering on the edge of disaster. But here's the twist. That young investor learned something that day that would transform his entire career. The lesson wasn't just, weird stuff happens. It was that the stock market has minefields in some places, and treasure chests in others. Getting rich isn't just about picking winners. It's about knowing where to look. That investor was Joel Greenblatt, one of the smartest and most successful investors most people have never heard of. Between 1985 and 1994, his firm Gotham Capital returned an almost unbelievable 50% per year. If you'd given him a single dollar in 1985, you'd have gotten back $52 by 1994. Then in 1997, he did something unusual. He wrote a book for regular people like us, pulling back the curtain on his secrets. It's called You Can Be a Stock Market Genius, Even If You're Not Too Smart. His promise is bold and simple. The stock market isn't a fair fight, but it's rigged in your favor. Those billion-dollar fund managers, with their fancy degrees and supercomputers, they actually don't stand a chance against a regular person who knows where the hidden opportunities are. Over the next hour, we're diving into those secret spots. We'll explore the forgotten corners of the market, the corporate junkyards, and the chaotic aftermaths of mergers and bankruptcies. You'll discover something profound. The best opportunities aren't in the headlines. They're in the footnotes. Not in the hot, glamorous stocks, but in the boring, complicated, and misunderstood ones. By the time we're done, you'll see the market not as a casino, but as a field of incredible, overlooked opportunities, just waiting for someone willing to do a little homework. Let's start with something that doesn't make sense. If making money in stocks is so accessible, why aren't the experts crushing it? You've got armies of finance PhDs, managers controlling more money than entire countries, and analysts with computer models that could probably predict next week's weather. What chance do we actually have? Here's Greenblatt's secret. Those experts are trapped. Let's look at the academics first. For decades, business schools have taught something called efficient market theory. The idea is that thousands of smart people are constantly analyzing every company. Through buying and selling, they set the correct price. The conclusion? You can't beat the market, so don't even try. They'll teach you complex formulas to match the market, but the message is basically, give up. Then there are the professionals, mutual fund and pension managers. They ignore the academics because their whole job depends on claiming their advice matters. But here's the funny part. The data shows they actually do worse than the market on average, even before you subtract their fees. Why? Greenblatt introduces us to his friend Bob, who manages $12 billion. If you stack that in $100 bills, it would be 20 times taller than the World Trade Center. And Bob's measure of success? Beating the market by just 2 or 3% a year. That's considered phenomenal in his world. The problem is, Bob's a prisoner of his own size. With $12 billion, he can't invest in small, undiscovered companies. He has to buy hundreds of different stocks, putting hundreds of millions into each. He's forced to buy his 50th best idea, his 100th best idea, his 200th best idea, not because they're great, but because he has to put all that cash somewhere. He's a giant trying to shop at a corner store. He can only buy the biggest, most popular stocks, exactly the ones where efficient market theory actually works. This is where our opportunity starts. We don't have $12 billion. We can shop anywhere. We can look in places that are too small, too weird, or too complicated for Bob. Greenblatt explains this with a surprising story. weekend antique shopping with his in-laws. They're not trying to predict which artist will be the next big thing. Their strategy is simpler. They go to out-of-the-way places, estate sales, dusty country shops, and ask one question. Is this selling for way less than similar pieces recently sold for at auction? They're not predicting the future. They're finding bargains in the present. And crucially, their advantage comes from looking in places where there's less competition from other informed buyers. That's the whole secret, says Greenblatt. Finding bargain stocks works the same way. The profits aren't in going head-to-head with Wall Street over Apple or Google. They're in the market's equivalent of Grandma's attic sale. He tells a great story about a plumber who visits a home, bangs on a pipe once and fixes the problem. He hands over a bill for $100. $100, the homeowner protests. All you did was bang on the pipe once. The plumber calmly replies, banging on the pipe was $5. Knowing where to bang was $95. This book is about knowing where to bang. Before we get to the treasure map, Greenblatt gives us essential tools. First and most important, do your own work. In these hidden corners, there won't be Wall Street reports or media coverage to guide you. You have no choice but to dig in yourself. But that's a blessing. It means your profits won't come from taking big risks. They'll be your reward for doing homework. Second, don't trust anyone. Not the broker with a hot tip. Not the analyst on TV. The whole system is full of biases. Analysts are incentivized to issue buy recommendations because it generates commissions. They fear getting cut off from company management if they say negative things. It's safer to be wrong with the crowd than right alone. Get comfortable being a lone wolf. The third principle is maybe the most liberating. Pick your spots. Greenblatt tells a wonderful story about summer camp and a kid named David Versatsky. David had one very specific, very strange talent. He could hit a net serve in ping pong on demand, where the ball hits the net and still lands on the other side. During the big final relay race, while other kids were running and swimming, David would calmly step up and thwack, 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 hit 3 in a row, saving his team crucial minutes. The point? If David could arrange his life so every competition was a net serving contest, he'd be undefeated. Life doesn't usually work that way, but the stock market does. As an investor, you can wait for the perfect pitch. There are no called strikes. You don't have to swing at every opportunity. You only invest in your net serve moments, those rare situations where you have overwhelming conviction, and you don't need many. Studies show that after owning just 6 or 8 stocks in different industries, adding more barely reduces risk. Putting your eggs in a few carefully watched baskets is actually less risky than you think, especially if your goal is to dramatically beat average returns. This leads to Rule 4, look down, not up. This is wisdom from Benjamin Graham, the father of value investing. Most people, including professionals, measure risk by volatility, how much a stock's price bounces around. Greenblatt says that's nonsense. A stock that goes up a lot is considered risky under that model, which is absurd. The only risk that truly matters is permanent loss. How much can you actually lose? Graham's secret was the margin of safety. It's the same principle Greenblatt's in-laws use. If you find a painting worth $10,000 and can buy it for $5,000, you have a massive cushion. Even if your assessment is slightly off or the market dips, that cushion protects you. The most important part of any investment decision is figuring out the downside. If you don't lose money, most of the remaining alternatives are good ones. So with our toolkit ready, where are these secret hiding places? Greenblatt says the theme is change. We're looking for corporate events so unusual, messy, or boring that other investors either ignore them or sell without thinking. The first and perhaps most lucrative hiding place is the corporate trash heap, a place called spin-offs. A spin-off happens when a large company takes part of its business and separates it into a new, independent company. Shares of this new company are given to the parent company's existing shareholders. Sounds simple, almost boring. But the results are explosive. Greenblatt cites a Penn State study covering 25 years of spin-offs. It found that, on average, spun-off companies outperformed their peers and the market by a staggering 10% per year for their first 3 years of independence. Even the parent companies did better than their industry averages. Think about that. If the market averages 10% returns, simply buying every single spin-off could theoretically get you to 20% annual returns. And if you learn to pick the best ones, the results can be truly life-changing. Why does this happen? And why does it keep happening, even though everyone knows about it? The answer is beautifully simple. The spin-off process fundamentally distributes stock to the wrong people. The new spin-off stock isn't sold to interested buyers. It's given to shareholders of the parent company, who never asked for it. Imagine you own stock in a giant, stable manufacturing company, and one morning you wake up with shares in a tiny, risky restaurant chain it used to own. What do? You sell. You sell immediately, without caring about price or value. You just want it gone. Multiply that reaction by millions of shareholders. The result is a flood of indiscriminate selling that has nothing to do with the new company's actual worth. This selling pressure artificially pushes down the stock price right from the start, creating a bargain for anyone willing to step in. It's not just individuals. Big institutions are often forced sellers too. A spin-off is usually much smaller than its parent. A pension fund that only owns large companies might receive shares in something too small for its mandate. So they sell, automatically. There's a second reason spin-offs do well. Once freed from its large corporate parent, entrepreneurial magic happens. The new management team is fully accountable. Their pay, often in stock options, is tied directly to their business's success, not some sprawling empire. Pent-up energy gets unleashed. So how do we find the very best spin-offs? Greenblatt gives us a simple 3-part checklist. 1. Institutions don't want it. The more reasons for institutions to sell for non-investment reasons, it's too small, wrong industry, looks messy, the better the potential bargain. 2. Insiders want it. This is the most important clue. Check the public filings. Is the new management getting huge chunks of their pay in stock and options? Are they incentivized to act like owners? If yes, you're on the right track. 3. A hidden investment opportunity is revealed. Sometimes a great business was buried inside a mediocre conglomerate, or a statistically cheap stock is uncovered. Often, a spin-off creates a company with tremendous leverage, which can multiply your returns. To see this in action, Greenblatt walks us through one of the most brilliant cases, the spin-off of Host Marriott from Marriott Corporation in the early 1990s. At the time, Marriott was in trouble. During the 80s real estate boom, they'd built tons of hotels, racking up billions in debt. Their real genius wasn't owning hotels, but managing them for others. When real estate crashed, they were stuck with mountains of debt and unsaleable hotels. Then a financial wizard named Stephen Bollenbach came up with a radical plan: split the company in two. One company, Marriott International, would get the crown jewels, the lucrative, high-growth hotel management business, basically debt-free. The other company, Host Marriott, would get the leftovers, the toxic waste, all the unwanted real estate, and essentially all the crushing debt. When announced, the press and Wall Street were ecstatic about the good Marriott and horrified by the bad one. Greenblatt's immediate thought was, who would want to own this toxic waste? His next thought was, I would. He figured the selling pressure on Host Marriott would be massive. No institution would hold this highly indebted, ugly duckling real estate company. This was the ultimate contrarian play. But it wasn't blind. He checked his list. First, did institutions want it? Absolutely not. It was debt-laden real estate, the opposite of the quality business they thought they owned. Second, did insiders want it? This was the kicker. The architect of the whole plan, Stephen Bollenbach, the guy who just saved Donald Trump's empire, was leaving the good Marriott to become CEO of the bad one. Why would the captain who saved the ship voluntarily jump into the leaky lifeboat? Greenblatt guessed Bollenbach knew something everyone missed, and that he'd be heavily incentivized. He was right. filings later showed management got incentives on nearly 20% of the new company's stock. Third, was a hidden opportunity revealed? Yes, tremendous leverage. Because the company was loaded with debt, even a small improvement in hotel values could massively increase the stock price. If Host Marriott's assets went up just 15%, the stock could nearly double. What happened? Just as predicted, institutions dumped their shares, creating bargain prices. Within 4 months, the toxic waste Host Marriott stock nearly tripled. Extraordinary profit from looking at something everyone else had written off. Another classic was the spin-off of Stratic Security, an automotive lockmaker from Briggs & Stratton, a small engine maker. Stratic was tiny, less than 10% of its parent's business, perfect for institutional selling. When public documents were filed, Greenblatt did his homework. He checked insider incentives. The plan reserved over 12% of shares for employees. Check. Then he did simple valuation work. He looked at what other auto parts companies were trading for and determined a reasonable price range for Stratic. It was decent, if unexciting. But then, buried in the business of the company section, he found treasure. The filing mentioned that based on current commitments, Ford was expected to become Stratic's second-largest customer in the coming year. This was huge news. All the historical earnings didn't include a single dollar from this massive new customer. He realized the market, rushing to discard this small, boring spin-off, would almost certainly overlook this critical information. He was right. For months after the spin-off, the stock traded at the low end of industry valuations, with no credit for the Ford business. He bought at very attractive prices. Less than 8 months later, the stock was up over 50%. These opportunities, where a little reading uncovers game-changing facts, are surprisingly common in spin-offs. Sometimes the value is hidden in the company's structure, not future growth. This was the case with Home Shopping Network. In the early 90s, HSN was a former high flyer that had fallen on hard times. It planned to spin off its broadcast television stations into a new company called Silver King Communications. HSN argued that Wall Street didn't know how to value it. It was part retailer, part broadcaster. Retailers are valued on earnings, but broadcasters on cash flow. HSN's broadcast stations had huge non-cash charges that crushed reported earnings, but didn't affect the massive cash they generated. By spinning off the stations into Silver King, HSN believed its retail business would be valued more appropriately. Greenblatt realized something fascinating. HSN wasn't just spinning off the broadcast division, it was also shifting over $140 million of debt onto the new company. The interest savings from shedding that debt were actually greater than the operating earnings HSN was giving up. From a reported earnings perspective, HSN would actually look more profitable without the broadcast stations. Meanwhile, the new spin-off, Silver King, was a cash-generating machine that most HSN shareholders were likely to ignore and sell immediately. Perfect setup. You could buy the parent company, which looked ready to go up, and get shares in a deeply misunderstood cash cow for free. It gets better. Sometimes a company doesn't spin off 100% of a division. It might sell just a small piece, say 20%, to the public. This is called a partial spin-off, and it creates a different opportunity, one requiring only basic math. The classic example was Sears in the early 1990s. Sears owned its famous retail stores, but also Allstate Insurance and Dean Witter Brokerage. Management felt Allstate and Dean Witter's value was being lost inside the giant conglomerate, so they announced a plan: sell 20% of both to the public, then later spin off the remaining 80% of Dean Witter to Sears shareholders. This created a magic moment. Once 20% of Allstate and Dean Witter were trading separately, the market had put clear price tags on them. You could now do simple subtraction. Take Sears's stock price, subtract the now known value of its Allstate stake, subtract the value of the Dean Witter shares you were about to receive. What's left is the price for the rest of Sears, primarily the giant retail business. The number was astonishing. The market valued Sears's $27 billion retail business at just $1.5 billion. You could buy the entire department store chain for about $5 per share, almost debt-free. A screaming bargain, hidden in plain sight, revealed by a spin-off and basic arithmetic. The most extreme and profitable spin-offs often involve something called a rights offering. Instead of giving shares away, the company gives shareholders the right to buy shares in the new spin-off. This structure is rare, but when you see it, Greenblatt says stop everything and take a look. Why? Because in a rights offering, insiders have a unique opportunity to set a bargain price for themselves. They're not selling to the public where they need the highest price. They're selling to their own shareholders. The grandmaster of this was John Malone of Telecommunications Inc., the cable giant. In the early 90s, facing regulatory pressure, TCI decided to spin off programming assets into a new company called Liberty Media. The deal Malone structured was artfully confusing, designed to be so complex, illiquid, and unattractive that almost no one would participate. First, shareholders got one right for every 200 TCI shares they owned. To exercise that right, they had to trade in 16 valuable TCI shares to get just one Liberty Media share. This worked out to over $250 per Liberty share. Very awkward and high. Total Liberty shares were capped at a tiny 2 million, ensuring the stock would be incredibly illiquid and unattractive to large institutions. The financial press called it, quote, one of the most complex transactions of its kind. Analysts said it had very limited appeal. Even Forbes advised readers to pass, pointing to Liberty's reported losses, without realizing those losses were meaningless because Liberty's assets were minority stakes whose earnings weren't reflected on the income statement. Perfect storm of confusion and disinterest. And what were insiders doing? John Malone, CEO of both companies, was taking huge compensation and options to buy 100,000 Liberty shares. At the low participation rate he engineered, this gave him a stake in almost 20% of Liberty's upside, compared to less than 2% of TCI's. He was massively incentivized to use TCI's power to make sure little Liberty thrived. The result? Only about 36% of rights were exercised. Most shareholders, confused and uninterested, let their rights expire worthless. But for those who did the work, understood Malone's incentives, and participated, the reward was legendary. In less than 2 years, their Liberty Media investment increased tenfold. The next hunting ground Greenblatt takes us to is the aftermath of chaos. Places like bankruptcy and corporate restructurings. He gives a stern warning. It's almost always terrible to buy common stock of a company currently in bankruptcy. When a company reorganizes, old stockholders are at the very bottom. They usually get wiped out completely. The real opportunity comes after the company emerges from bankruptcy. This is when former creditors, banks, bondholders, suppliers, are given new stock in the reorganized company in exchange for the debt they were owed. Think about it. The new owners are people who never wanted to be stockholders. They're creditors, stuck with unwanted, illiquid stock in a company with bankruptcy's stigma. What do? They sell. This creates what Greenblatt calls orphan equities. These stocks have no natural shareholder base. Wall Street analysts aren't covering them yet. The vultures have picked over the carcass, and now the stock is left alone, often trading at a deep discount to its true value. The key is picking your spots. Look for good businesses that ended up bankrupt, not because they were failing, but because they were over-leveraged, often from a previous takeover or buyout. A great example was Charter Medical, an operator of psychiatric hospitals. It went bankrupt after a management-led buyout loaded it with too much debt. When it emerged, it was an orphan stock, but research revealed it was trading at a substantial discount to competitors. The business was stabilizing, insiders had significant stakes, and the leverage, while still high, offered huge upside. The stock went from around $7 when Greenblatt found it to over $21 in about 15 months, nearly 200%. This brings up a crucial question: when do you sell? Greenblatt's advice is simple: These special situations create buying opportunities with well-defined time frames. You're buying because of neglect and misunderstanding following an extraordinary event. Once the story is out, once Wall Street starts covering the stock, and the price reflects the value you saw, your initial advantage is gone. Time to sell and move to the next undiscovered opportunity. Similar to bankruptcies are corporate restructurings, where a company sells or shuts down a major division, often to stop losses or focus on core business. The opportunity is that the market may have valued the entire company based on the money-losing division. Once that's gone, the profitability of the remaining good business is revealed. One of my favorite stories involves Greenblatt's wife. She discovered a new educational toy store called Noodle Kidoodle and was incredibly impressed. She found out it was owned by a public company called Greenman Brothers. Greenman's main business was a boring, marginally profitable toy distributor. The stock traded around $5 per share, but book value, the value of its assets, was over $8. Greenblatt realized the market was giving zero value to the exciting Noodle Kidoodle concept. He was getting a free bet on a promising retail chain, with the old distribution business providing a strong margin of safety. Sure enough, months later, Greenman announced a major restructuring, selling the old distribution business to focus entirely on high-growth Noodle Kidoodle. Suddenly, the stodgy company was a fast-growing retail dynamo. The stock shot from $5 to over $14 in months. Hidden value unleashed. Our final destination is for the truly adventurous. But first, a warning. Greenblatt tells us about risk arbitrage, buying stocks after a merger is announced, trying to capture the small spread between trading price and deal price. His advice? Don't try this at home. It's a game for professionals with teams of lawyers and minute-by-minute information. It's picking up nickels in front of a steamroller. This is where he tells the Florida Cypress Garden sinkhole story, a vivid reminder that in arbitrage risks are often hidden and rewards too small to compensate. The real opportunity in the merger world isn't arbitrage. It's in the strange securities sometimes created in these deals, merger securities. Often in a takeover, the acquiring company pays not just cash, but a mix of bonds, preferred stocks, or warrants. Shareholders of the acquired company receive this funny money and, like with spin-offs, don't want it. They sell immediately, creating bargain prices for those who know to look. A perfect example was the Viacom takeover of Paramount Communications. Huge, front-page battle. But the real money wasn't made during the fight, it was in the aftermath. Paramount shareholders received a complex package of Viacom stock, debentures, warrants, and a strange security called a contingent value right, or CVR. Almost no one bothered reading the proxy statement to figure out what these were, but Greenblatt did. He discovered the CVRs acted like insurance on Viacom's stock, and the warrants had a hidden feature. If Viacom completed another planned merger with Blockbuster, the exercise price would reset to a much lower, more advantageous price. This tiny detail, buried in a 3-page section of a multi-hundred-page document, created a massive opportunity most investors completely missed. This idea of leverage and limited downside leads to Greenblatt's final powerful tool, creating your own leveraged situations. He explains recapitalizations, where a company borrows huge amounts to pay a large one-time dividend to shareholders. What's left is highly leveraged A small improvement in the business can lead to explosive gains in the stub. The classic case was FMC Corporation in the 1980s, which paid an $80 cash dividend. The remaining stub stock, which could be created for a net price of $17, soared to over $40 within a year. While recaps are rare today, Greenblatt shows how to create your own stub stocks using LEAP's long-term options. A LEAPS gives you the right, but not obligation, to buy a stock at a set price for up to 2 or 3 years. It gives you all the upside of the stock, but your loss is limited to the leap's price. It's leverage with built-in margin of safety. The key is using leaps not for wild speculation, but to enhance an already great investment idea. He tells how he stole an idea to invest in Wells Fargo Bank in the early 90s. The bank looked incredibly cheap, but he worried about its exposure to shaky California real estate. Instead of buying stock at $77, he bought leaps, giving him the right to buy at $80. He paid about $14 for these leaps. His thinking was brilliant. If the bank survived and thrived as expected, the stock could double to $160. His $14 leaps would be worth $80, nearly five-fold return. But if California real estate imploded and the stock went to zero, he'd only lose $14, not the full $77. He used leaps to create an even better risk/reward situation, a bet where potential gain was 5 times potential loss. That, in essence, is the genius of Joel Greenblatt's approach. It's a constant search for asymmetric bets, situations where downside is limited and understood, and upside is open-ended and explosive. These bets aren't in the mainstream. They're in spin-offs nobody wants, orphan equities nobody follows, merger securities nobody understands, and restructurings nobody has patience for. It's a world away from the crowded, efficient market of the experts. It's a world where a little homework can indeed make you a genius. As we step back and look at the landscape Joel Greenblatt has mapped out, what's the single most powerful lesson? I believe it's this. The stock market isn't a test of intelligence. It's a test of discipline and perspective. The world constantly tries to pull your attention toward noise. Daily headlines, hot stocks, the next big thing. Wall Street built a multi-trillion-dollar machine to focus you on what's popular and exciting. Greenblatt's entire philosophy is a quiet rebellion against that machine. He's telling us to turn away from the noise and look toward the silence. Look where things are complicated, boring, where there's been failure. Because it's in these neglected corners that value truly hides. The market is efficient, where attention is focused. Our job is to go where the attention isn't. This isn't just an investment strategy. It's a profound way of thinking, about developing an independent mind, about trusting your own research over the roar of the crowd, about having patience to wait for the perfect pitch, knowing you don't have to swing at everything. So how can you start applying these ideas today? It can feel overwhelming, but the first steps are surprisingly simple. First, start reading business news, like the Wall Street Journal, with new eyes. Don't just scan headlines. Look for magic words: spin-off, restructuring, rights offering, merger securities. When you see one, clip the article or save the link. Start a file. You're not investing yet. You're learning to spot opportunities in the wild. Second, pick one area that fascinates you most. Maybe it's spin-offs. Spend a month or two just following spin-off stories. Get the public filings. They're free online through the SEC's Edgar system. Practice looking for the 3 key things. Do institutions hate it? Do insiders love it? Is there a hidden gem in the details? You'll be amazed at what you find when you're the only one looking. Finally, remember the core principle underlying it all. Look down, not up. Before getting excited about how much you can make, get obsessed with how much you can lose. Margin of safety isn't just an accounting term. It's a philosophy for survival and success. If you can protect your downside, the upside will almost always take care of itself. The journey to becoming a stock market genius isn't a sprint to a finish line. There is no final destination. The fun, as Greenblatt says, is in getting there. In the challenge of the puzzle, the thrill of the hunt, and the deep satisfaction from knowing you earned your success not through luck or hot tips, but through your own diligence, curiosity, and hard work. That was a summary of You Can Be a Stock Market Genius by Joel Greenblatt. We've covered the core strategies and big ideas today, but I have to be honest. A summary is like looking at a map of the Grand Canyon. The map is useful, it shows you the path, but it can never capture the feeling of standing at the edge, seeing the colors change with the sun, experiencing the sheer scale for yourself. The real magic happens when you read the book. It's in Greenblatt's witty stories, his detailed examples, and the way his thinking slowly changes your own. This summary is designed to help you decide if this journey is for you. If anything we've talked about has sparked your curiosity, I urge you to grab a copy. Reading it isn't just learning, it's an apprenticeship with a master. The link to the book is in the description below. Also, if you found this summary valuable and want to continue exploring the world's most powerful ideas, please take a moment to hit that like button and subscribe to the channel. That way you won't miss our next journey into another life-changing book from the Billionaire's Bookshelf. Let's keep learning and keep growing together.